Hello, economics enthusiasts. Welcome to E for Education, your source for simplified economics knowledge. Our aim here is to make the complex world of economics accessible and engaging. Today, we're diving into the concept of international liquidity. So, buckle up for an enlightening journey. International liquidity sounds sophisticated, right? But don't worry, we're here to simplify it for you. Now, think of international liquidity as a country's financial strength, its ability to pay off foreign obligations. These obligations could range from international trades to foreign debts. But what determines this strength? Three essential components contribute to a country's international liquidity. First, the country's foreign exchange reserves. These are assets held by a country in foreign currencies. Second, the country's reserve position in the International Monetary Fund, or IMF. This is essentially the country's credit line with the IMF that it can use when needed. And lastly, the country's holdings of special drawing rights, or SDRs. These SDRs are international reserve assets created by the IMF and can be exchanged for freely usable currencies. So, in a nutshell, international liquidity is all about a country's capacity to pay for its foreign obligations. Now that we know what international liquidity is, let's delve into its importance and impact. Picture this: international liquidity is like the oil in the engine of global trade. Without it, the engine seizes up and the wheels of commerce grind to a halt. This is because international liquidity, which refers to the readily available resources for international payments, plays a critical role in facilitating cross-border transactions. When there is adequate international liquidity, countries can easily settle their international obligations. They can buy and sell goods and services, invest in foreign markets, and repay their debts to other nations. This smooth flow of payments is what keeps the machine of global trade running. But what if there's not enough oil, or in our case, international liquidity? Well, that's when things get tricky. A shortage of international liquidity can lead to financial crises. Countries may struggle to meet their international payment obligations, which can trigger a domino effect of financial instability. We've seen this happen before, during events like the Asian financial crisis in the late 90s. Now let's flip the coin. What happens when there's an abundance of international liquidity? It's not all roses and sunshine, I can tell you that. Sure, it promotes economic stability and encourages international trade, but too much liquidity can also lead to imbalances. Countries may take on excessive debts or engage in risky investments, which can create economic bubbles. So, you see, it's all about balance. Too little international liquidity, and we risk financial crises. Too much, and we risk economic bubbles. The Goldilocks zone, if you will, is having just the right amount of international liquidity. It's a delicate balancing act, but when done right, it can promote economic stability and prosperity. In the grand scheme of things, international liquidity is not just about making payments. It's about fostering international cooperation, promoting economic growth, and maintaining global financial stability. Therefore, international liquidity is a key player in maintaining global financial health. Let's break down how we calculate international liquidity. This is a three-step process where we account for three main components. The first component is a country's foreign exchange reserves. These reserves are typically made up of foreign currencies that a country's central bank or government holds. These currencies can be used to influence the country's own exchange rate, pay for imports, or settle international debts. The second component of international liquidity is a country's reserve position in the International Monetary Fund, or IMF. This refers to the amount of financial resources a country can draw from the IMF without needing to provide additional economic measures or assurances. It's essentially a country's credit line with the IMF, giving it access to foreign currencies in times of need. The third and final component is a country's holdings of special drawing rights, or SDRs. SDRs are international reserve assets created by the IMF to supplement its member countries' official reserves. They aren't a currency per se, but rather a potential claim on the freely usable currencies of IMF members. Now, how do we bring these three components together to calculate international liquidity? We simply add them up. We take the value of a country's foreign exchange reserves, add its reserve position in the IMF, and finally, add its holdings of SDRs. It's important to note that these values are usually expressed in a common currency like the US dollar for consistency and comparability. Also, while this calculation gives us a snapshot of a country's international liquidity at a given point in time, it's a dynamic figure that can change as a country's economic conditions and policies evolve. So, in essence, international liquidity is a measure of a country's ability to make international payments, and it's calculated by summing up the value of its foreign exchange reserves, reserve position in the IMF, and holdings of SDRs. And voila, that's how we calculate international liquidity. Now, let's take a real-world example to understand international liquidity better. Picture this. The year is 2024, and we're amidst a global financial crisis. The fictional country we'll call Economia is in dire straits, struggling to manage its foreign payment obligations. Economia, like many other nations, has a blend of assets it can use to meet these obligations, namely foreign exchange reserves, gold holdings, and drawing rights from international institutions like the International Monetary Fund. These form Economia's international liquidity. As the crisis deepens, Economia's exports take a hit, and its regular flow of foreign currency dwindles. This puts pressure on Economia's ability to pay for its imports and repay its foreign debt. However, Economia's central bank had been prudent. It had built up a sizable reserve of foreign currencies and gold during the good times. Now, using this international liquidity, Economia can continue to pay for its imports, service its debt, and stabilize its currency, despite the hit to its export revenues. This is the essence of international liquidity. It's like a rainy day fund for countries, allowing them to weather financial storms and keep their economies functioning. On the other hand, consider a positive scenario. Let's say Economia and its neighboring country Tradeland have been trading partners for decades. Economia exports machinery to Tradeland and in return imports raw materials. Now imagine a scenario where Tradeland suddenly needs more machinery from Economia to meet its growing industrial demand. Economia, having enough international liquidity, can quickly ramp up its machinery production and export more to Tradeland, thereby earning more foreign currency. This is another instance where international liquidity aids in facilitating international trade. These examples, though simplified, illustrate the fluid nature of international liquidity and its role in helping countries navigate through both turbulent and prosperous times in the global economy. This example gives us a clear picture of how international liquidity works in the real world. And that's a wrap on international liquidity. We've unpacked the concept, delving into its definition as the ease of converting foreign assets into cash or other liquid assets. We've discussed its profound impact on global trade, financial stability, and economic growth. We've also walked you through its calculation, emphasizing the role of foreign exchange reserves, gold reserves, and international credit. And we've brought it all home with a real-world example, demonstrating how international liquidity plays out in the global economy. If you enjoyed this video, please hit that like button. Don't forget to subscribe to E for Education for more simplified economics content and share our videos with your friends. Until next time, keep learning.